silver investors need to pay very close attention right now. As we move through late February 2026, silver is trading in a highly sensitive zone after weeks of volatility and renewed safe haven demand driven by global uncertainty, tariff tensions, and shifting monetary expectations. The metal is once again building pressure, and here's the truth most people don't want to hear. The next move in silver is likely to be aggressive, not slow, not gradual. Aggressive. The only question is direction. Because right now, silver is sitting at a decision point that could either launch it toward triple digits later this year or trigger a sharp shakeout that wipes out overconfident traders. Let's break this down calmly and logically. Over the past several months, silver has experienced powerful swings. We saw strong upside momentum driven by industrial demand optimism, especially from solar and green energy sectors. We also saw waves of buying as investors sought protection from inflation uncertainty and geopolitical instability, but after strong moves, markets rarely continue straight up. They compress, they stall, they test patience. And that's exactly what silver has been doing. Price action has tightened. Volatility has contracted compared to previous spikes. Yet beneath the surface, something important is happening. Buyers are stepping in on dips. This is not random behavior. When you see repeated support holding despite negative headlines, it suggests underlying demand remains present. At the same time, we cannot ignore macro pressure. The U.S. dollar's movements, interest rate expectations, and broader equity market sentiment are still influencing silver heavily. If bond yields rise aggressively, or if risk assets face sudden liquidation, silver could temporarily get caught in the crossfire. This is why the current setup is so critical. We are in an environment where both bullish and bearish arguments sound convincing. Let's examine the bullish case first. Industrial demand remains structurally strong. Silver is not just a monetary metal, it is deeply embedded in electronics, renewable energy infrastructure, EV production, and semiconductor manufacturing. Global electrification trends are not slowing down over time. That creates a structural floor under demand. On top of that, supply growth has not kept pace proportionally with projected industrial consumption in some forecasts. That imbalance does not guarantee higher prices tomorrow, but it supports long-term bullish pressure. Add monetary uncertainty to the mix. Even though inflation has cooled from previous highs, global debt levels remain elevated. Central bank policy shifts continue to create volatility. In such environments, investors often rotate into tangible assets. If momentum reaccelerates and silver breaks key resistance zones with strong volume, we could see a powerful upside expansion. Historically, when silver exits multi-month consolidation ranges, moves of 30 to 60% are not unusual. That is how triple-digit projections start entering the conversation. But now, let's slow down and examine the other side. Silver has a reputation. It is known for fake breakouts. It is known for sharp rallies that attract retail excitement, followed by rapid pullbacks that punish late buyers. If the dollar strengthens unexpectedly, if macro data surprises markets, or if broader liquidity tightens suddenly, silver could retrace quickly before any sustainable breakout occurs. And here is where psychology becomes the real battleground. Most investors do not fail because they misunderstand supply and demand. They fail because they mismanage emotion. When price spikes upward, fear of missing out takes over. People chase. When price drops sharply, fear of loss takes over. People panic. The market exploits both. Right now, sentiment in silver is divided. Some traders are confident the metal is preparing for a major breakout phase. Others are convinced that a deeper correction must come first. This emotional split is important. Major moves often begin when conviction is fractured. From a structural standpoint, silver is building pressure. Higher lows have formed on broader time frames, suggesting accumulation behavior. Volume activity has increased during key support tests, implying dip buyers remain active. Momentum indicators are stabilizing rather than collapsing. That does not confirm a breakout, but it does signal compression. And compression phases do not last forever. Think of it like a coiled spring. The longer price tightens within a range, the more powerful the eventual expansion tends to be. Now, imagine this scenario. Silver clears a major resistance level decisively. Volume surges. Short sellers begin covering positions. Momentum traders jump in. Headlines amplify the narrative. Retail investors see price accelerating and rush in. That feedback loop can push price dramatically higher in a short time frame. That is how parabolic phases begin, but parabolic phases carry risk, because once price becomes extended, the same emotional intensity that fueled the rise can accelerate the fall. The real danger is not missing the move. The real danger is having no plan during the move. If silver drops 15 or 20% suddenly, will you interpret that as failure or as volatility within a larger structure? If silver rallies 40% rapidly, will you take partial profits or assume it can never retrace? Preparation separates disciplined investors from reactive ones. Now let's talk timing. We are heading into a period where macro headlines remain sensitive. Trade policy uncertainty, geopolitical developments, and monetary expectations are all capable of shifting sentiment quickly. That increases the probability of volatility. When volatility probability rises, the chance of a significant directional expansion increases as well. Silver is not drifting quietly in the background. It is sitting at a crossroads. One path leads to renewed bullish momentum and potentially a run toward new highs later this year. The other path involves a sharp shakeout designed to test conviction before any larger trend resumes. Both scenarios involve movement. Stagnation is becoming less likely. And this is where discipline matters more than prediction. Instead of obsessing over whether silver will hit a specific number, focus on your framework. What is your allocation size? What is your risk tolerance? Where would you reduce exposure if price accelerates? Where would you reassess if support fails? Professional traders do not wait for clarity after the move begins. They create clarity before it begins. Silver's next move will shock investors, not because it is unpredictable, but because most people will not be mentally prepared for its speed. Whether the next expansion is upward or downward, it is unlikely to be slow and comfortable. Volatility rewards preparation. It punishes hesitation. So as we move deeper into 2026, the key question is not whether silver is bullish or bearish. The key question is whether you are structured and disciplined enough to handle either outcome. Because the compression phase we are witnessing rarely resolves quietly, a significant move is forming, and when it arrives, it will not wait for anyone to feel ready. Stay focused, stay strategic, and most importantly, stay prepared.